purchase product. Number to close more sales on listings that you currently have with senior sellers. You should be able to help more senior buyers purchase properties at a higher level, which means more commission for you than what's currently expected. I have a question. How many people in the room were aware that reverse mortgages could be used in a purchase scenario? Okay.
Is your microphone on?
Is it? Oh, you know what? That would help.
There we go.
Is that better?
Is that better?
Okay.
Thank you.
Okay, so a few of you are aware of it, but the ones that weren't, you're not alone, which is part of the reason I'm so happy to be here, to be able to kind of spread the word on what the home equity conversion mortgage can mean to you and to your customers. So I want to just start with just a few facts about the potential volume of buyers and sellers that are out there for you to keep your eyes peeled for. Maybe buyers and sellers that you wouldn't have wanted to invest too much time in the past, but with the dynamics of the HECM product, it's going to be worth some of your time to work with these people. So here's some U.S. facts. That there are over 23 million total senior homeowner households in the United States, of which about 6% relocate on a yearly basis. That leaves us about 1.4 million. Of that 1.4 million, about 20% currently have mortgages on their property. That leaves us 280,000 that are potential sellers. And of that 280,000, about 25% opt to do a reverse mortgage. That's about 70,000 potential sales just by virtue of this product. The two largest states that utilize this product in the country are Florida and California. So being in Florida, there's a disproportionate amount of this 70,000 that's going to fall into your area. People who are eligible, wanting, and needing this kind of product to help them make a move. So is anybody here working with a senior customer? When I say senior, I mean age 62 or older, a buyer or seller right now? Anybody in the room? Selling, buying?
Buying.
They're buying?
Yeah.
Okay.
Yes.
And did they have a departure home? They sold a home, or they're in the process of it?
What I'm looking for is actually my sister. She lives up in Illinois. I wanted to get down here, and she had real trouble selling her house, or her townhouse rather. And I was thinking possibly she can get a reverse mortgage and maybe have enough cash to buy a little condo down here, because that's really all she needs, something smaller here, and then keeping her place up north.
Okay, so she's trying to sell a property up north, and she wants to sell it and make this a primary residence for her down here.
Yeah, but
and she's going to be limited from the sale proceeds, from the sale of her house as her down payment, or...
Yeah, well, she really is looking to see if there's any way she can get cash out of her, with a reverse mortgage up there, and have enough cash to buy something for cash here instead of getting a mortgage.
Okay, so let me give you a couple of basic facts about reverse mortgages. Number one, you have to be age 62 to qualify. You have to be either refinancing or purchasing a primary residence. This is an FHA loan, so challenges with condominiums, especially in the state of Florida, are ever present. But there are some FHA-approved condos that can use any FHA product, including a reverse mortgage. Your credit score is irrelevant. Your income is irrelevant. So if you have two customers and one has an 800 credit score and the other has a 400, they're the same exact age, and one of them has $1 million in the bank and the other has $0 in the bank, they're going to get the same exact amount of money from the reverse mortgage, because it's all driven by the value of the property that they're purchasing, by their age. That's the age of the younger of the two borrowers, between typically a husband and wife, and the current interest rate. So whatever numbers I'm going to share with you today, it's a fluid situation. They're based on what the rates are today. If rates go down tomorrow, people get a little bit more money. If rates go up tomorrow, people get a little bit less money. But we have to, just kind of take a snapshot in time to review what this talks about. So Here's the basic scenario that I wanted to share with you. Give me one quick second. If you have a seller who's going to sell a departure home and clear about $113,000 from that departure home, that's going to be their net profit after the closing. They're probably going to come to you and say, I want to buy something in cash because I'm 62 years old and I don't want to take on a mortgage. I'm concerned about other things, about supporting myself through retirement years. So I have to buy a house for $113,000. That's what I have to work with. So the gift that I have to give you today is that that's not true. If that $113,000 is available in cash from a departure home, your 62-year-old buyer can turn around and buy a $300,000 property. And, I'm sorry, a 72-year-old buyer could buy a $300,000 property because the reverse mortgage will bring the rest of the money to the table along with that $113,000. And your buyer is never going to be required to make a monthly payment. It's not a free mortgage. It's not that there's not a mortgage that's accruing with interest charges. They're just never, ever required to make a monthly payment. They remain the owner of the home, like they had bought it outright or they had taken another mortgage. There's simply a lien against the property, and there's some built-in safeguards that I'm going to share with you a little bit later. But that's a very dynamic thing. So if you have a seller who's saying, I have to sell for X amount of dollars, because if I can't get $113,000, I can't buy $113,000 because they're not really willing to put anything more into it, or they're certainly not willing to take a mortgage. And that's a very common thing. Would everybody pretty much agree with me that a lot of 62-plus buyers are not really interested in taking on a mortgage at that point? Okay, I'm seeing a lot of heads shaking. Yes, that's the case. Okay, so here's how the numbers kind of run. That same 62-year-old buyer might need $129,000 to buy a $300,000 house. A 72-year-old buyer is going to need only $113,000, and actually an 82-year-old buyer is only going to need about $88,000. So if you stop to process that for a second and you realize $88,000 in cash can buy you a $300,000 property. Now, once you're in that property, you're a homeowner. So you have the same responsibilities as any other homeowner. You have to pay your taxes, you have to pay your homeowner's insurance, you have to pay your homeowners association fee, you need to maintain the property. You're a homeowner, you can't abandon that. But that house is yours until basically you either sell, move, or die. Until such time that maybe title changes on the property. So a sale or a death is what's going to affect title. What we're used to hearing in mortgages is that you get a 15-year, a 25, or a 30-year, and at some point there were 40-year mortgages that were available. The date that a reverse mortgage actually comes to an end is on the 150th birthday of the youngest borrower. So, I mean, that's kind of like, it's intended to be a lifetime program. So as long as it's your primary residence, you're paying your taxes, your insurance is covered, you're living in the property as your primary residence, nothing's going to happen to you while you're in that house until you get to be age 150. And I've told lots and lots of people, if you get to 150, the bank's not really, I can't imagine that would not be good publicity for any bank to come after you to foreclose at 150, I think they'll probably extend the date if people start living that long, but it's probably not going to be anywhere in our lifetime. Does anybody have any questions so far about the dynamics of how this works? No? Okay. So I wanted to tell you a story about a customer that I had worked with. This was about 4 years ago. They were living at that time, condos weren't such an issue. They were living in a community, and a lot of younger people had moved into the community, and they were 82 years old, and they liked to take walks at night, and they were getting nervous. There were a lot of teenagers around. So they basically just wanted to move to another zip code. But they knew that their property was, they were only going to net something around $140,000 from that property. And where they wanted to go was another community, but they knew it was going to cost them about $180,000, $190,000 to make the move. At 82, they were not interested in any kind of mortgage, and they certainly didn't want to come out of pocket for any kind of cash. So much to the happiness of the realtor that they had decided to work with, this transaction took place. The home was sold. They netted their approximately $140,000. They bought something for $190,000. They were able to take their $140,000, $40,000, $45,000 from the reverse mortgage, and then they walked away living in their new home with money left in a line of credit that they were able to access from the reverse mortgage. They paid all of their moving expenses. They painted, carpeted, and got all new appliances. So they not only made a move to another location, they wound up improving their entire financial plan. You know, here they are in their early 80s, no commitment to a monthly payment on a mortgage, and having an emergency fund left sitting with reverse mortgage money. And they could have done it either way. They could have kept cash or money in a line of credit from the reverse mortgage. I want to go back and just explain to you a little bit about the term HECM. Reverse mortgage is just a common term for this product, but the real technical name for it is HECM, and that stands for a home equity conversion mortgage. This is a product that is insured by the federal government and has been since the late 80s. Back in the 1960s, there were banks and lenders that came up with the reverse mortgage idea, and unfortunately a lot of people were burned in the 1960s and in the early 70s until the government got involved. This is one thing the government really did a good job at. They not only charged exorbitant high rates because it wasn't regulated, they also took an equity position in the ownership of the property. So as you're out and about, and I'm sure you all read the newspaper, you know, it's very frequent that we see a headline of something negative with a reverse mortgage. And what they're typically referring to are stories that took place, and they're true stories, that took place back in the 1960s and the 1970s. Because the HECM product, which is the one that is insured by the federal government, those things can't happen anymore. There are all kinds of caps and safeguards that are built into the system to protect the senior and the dynamics of the program, how the program actually unfolds. Okay. There are a couple of important things when you're working with buyers and sellers to keep in mind. And not that you need to be an expert on all of the ins and outs and the details of a reverse mortgage, but I want you to just have heard what some of these things are, that a seller, whether it's new construction or a resale property, that seller can't contribute to a closing, where a lot of times you have sellers contributing to closing costs and doing other things. Repairs on a property, because this is going to be an FHA appraisal that's involved, repairs have to be done prior to closing, so it would be something that your seller would have to, put the house into good condition so it could pass the FHA appraisal. Gift money is permissible as long as it's somebody who's not involved in the transaction, like a builder, or the seller can't gift money to the buyer in that kind of situation. It's got to be arm's length. And I think one of the most dynamic things that's so helpful today is that credit score and income has no bearing on approval for a reverse mortgage. Just absolutely no bearing. So I know there's some wonderful FHA products out there now that run into down to like 500 or something that you can get approvals for, but You're not documented to death, which is happening in the regular mortgage world, because they're not trying to qualify you for your ability to make a payment back. The whole premise of this is that it's a collateralized loan. And at some point, the investor is going to make their money back. At some point, that property is going to get sold or refinanced for whatever reason. So they don't have to qualify you on your ability to pay back. It's a very simple situations. Trusts can be used when you're doing a reverse mortgage. Life estates can be used when you're doing a reverse mortgage. And the primary residence, this program was not built to help somebody who wants to have a rental property or a second home. So when in the reverse mortgage world, when you talk about a primary residence, it's not that you have to be willing to live in that house 12 months out of the year. I know the state of Florida has certain requirements of what constitutes residency. But what we're looking for in the reverse world is that your license is at that address, that your taxes are filed from that address, that you vote from that address. So you can own 5 other properties, all over the country. You can travel. You can, if you need to, you can go into a rehab situation because you fell and you broke a leg or something, and you can be out of your home for months at a time. But bottom line is, this is still considered your primary residence. And if it ceases to be your primary residence, well, then at that point, you probably want to be selling your property anyway. That's the basics of it. So your sellers who are telling you, yeah, go ahead.
Can you have a mortgage on a second home that's like an income-producing home, and then you buy the new home as your primary residence?
So you own a home, and you want to buy a new primary residence, but you want to keep your other home as income property?
Correct.
You can do that. They're probably going to ask to validate that you can afford whatever mortgage payment is on that other property, that you can, they're not going to want to encourage somebody to abandon another property that has a mortgage on it. So they might ask for a little bit more documentation in that situation. But yes, you can own multiple homes. You can, actually, I just finished a loan for somebody. The man owned about 5 properties, all investment properties. But the reverse mortgage was done on his primary residence. So, does anybody else have any questions at this point? Yeah.
How about this situation? Say you were working with someone 62 or over,
Okay.
that would qualify for this. They can use it for a purchase. Could they don't have to be selling a home.
No, they don't have to be selling a home. Typically, that's what we see.
Do they have to make a down payment like that they show mortgage?
I'm sorry, I didn't hear that.
Down payment.
The down payment, well, the reverse is only going to give them a portion of the equity that's in the property that they're buying. And I actually ran a couple of numbers to give you an idea. As the interest rates are right now, somebody who is 62, the reverse mortgage is going to give them about 57% of the property. So if somebody's trying to buy a $100,000 property, the reverse will give them $57,000. They're going to need the cash for the other part, which is typically why we see a departure home and the proceeds from the departure home, that cash being used to come to the closing table with the $57,000 from the reverse mortgage. Does that answer your question? Okay.
Getting back to what you just said.
Sure.
So 62 is the youngest year that you can participate.
Right.
And the older you get, the less down payment you need.
That's right.
And if 43% then is the down payment they would need there, because 57 is for
Right,
the reverse.
43.
So 43 is the if someone has 43% down, they're going to hear the word yes.
That's exactly right.
So that's the number we should be focusing on.
Right.
Okay. And then
No, but those numbers, those percentages are going to change. As interest rates come down, more money's available. So that 57 could wind up going to 59%. If interest rates climb a little
Are
bit.
there different programs that would have different numbers, like you have a 30-year fixed program versus an adjustable program that might also be different numbers?
Yes, and what I just told you was the program that bears the most fruit, because in a purchase scenario, that's usually what people are looking for, okay? So there are two basic categories of reverse mortgages. One is driven by a fixed rate. The other is driven by an adjustable rate. Within each of those programs, fixed and adjustable, there's a saver program that kind of works like a home equity line of credit. So maybe somebody's buying a they netted $300,000 from their home, and they don't want to buy another $300,000 home because sometimes downsizing can be more expensive. That lateral move can wind up being a greater expense. They want more amenities or a different location or something. So they might not be looking for a $600,000 property. Maybe all they want is another $75,000. So there are other programs, and some of the fees are a little bit less in those saver programs, because basically the risk is less to FHA and to the investor. The less they lend you, the greater chance they have of recouping everything that they lent you and all of the fees that have accumulated over some period of time before the bank and the investors get paid back. Because the dynamics of the reverse mortgage is that you're not making payments, so you have a growing loan balance. And in theory, if your loan balance is growing, your equity position is decreasing. Where in a regular mortgage that you've all been very familiar with, you make a payment every month, so you have a declining loan balance, and you have an increasing equity position. Is that kind of clear to everybody? It's all based on a concept called negative amortization. It's not that there isn't interest, you're just not required to make a payment on it. That's all. That's the way that it goes. Did I finish answering your question?
Perfect.
Okay. So an age 62 person who wanted the least amount of money that was available, least amount of fees that are incurred, they'd get about 39%. But that same person, if they wanted to go to the fixed rate program that yielded the most amount of money, that's when they'd get about 57%. So there's a range there. The product itself is kind of maturing. So there are more opportunities. And the reason that saver program even came into existence, it's more like a home equity line of credit. Somebody might say, I don't need $200,000 for my $400,000 property. I just want to, in a refinance situation, I just want to buy a $50,000 car or something, and that's all. I just don't want to have to make payments on it. So they can take out a smaller version of the loan. It's getting to be more custom tailored. There are scenarios, and actually I'm working with somebody right now who's in Pennsylvania, and they want to buy a property in Florida that they're looking to at some point let this become their primary residence, but they're not ready for that yet. So they're going to take their primary residence that's in Pennsylvania, they're going to do a reverse mortgage on it. They're going to take the proceeds from that reverse mortgage. Nobody ever asks you what you do on that reverse mortgage, what you do with the proceeds, but their choice is they want to come down to Florida and buy a property. They'll buy it 100% in cash at that point, and they'll have a reverse mortgage on their primary residence. So I don't think you run into that as often in Florida, that somebody wants to do a reverse and go to California and buy something. This is usually the destination, where people are coming with cash. But I guess anything's possible, maybe from one coast to another, for family reasons, but that's a possibility. Yeah.
In a declining market situation, will they ever reevaluate the value of the home? Like, for instance, someone that may have gotten a reverse mortgage 5 years ago when property values were at a peak, this program would have naturally taken a little bit of a beating if they did a 70%.
And it did. I mean, the program did take a beating.
Have they changed? Are they reevaluating in a declining market situation and maybe lowering those lines of credit that are available to the consumer?
There really hasn't been any main structure change to the program. One thing that's probably going to happen is that FHA in the sets limits nationally for what's the largest amount they'll lend from, and for reverse mortgages, and I think even for forward, it's 625.5. The talk in the industry is it's probably going to come down, because there was a time that $625,000 homes were almost still part of an underserved population, but that's not the case anymore. So we're going to see that limit come down to 417. As far as once you're in the program and your appraisal has been done and your benefit has been calculated and it's done, you've closed on the loan, nobody's ever going to come change anything, do anything. You've got a binding agreement on file at the courthouse. I mean, these are, contracts and deeds and mortgage notes, so nothing's going to change. Should the market go back up again, there's a refinance opportunity in reverse mortgage, and it's actually called HECM to HECM. There has to be enough benefit. And 4 or 5 years ago, we saw a lot of that. A lot of that. People, they appraised for $300,000, and 6 months later, the house was valued at $450,000, and they refinanced and got more benefit. HUD took a hit on those kinds of things. Yeah.
The closing costs, aren't the closing costs pretty high?
No, they used to be. They used to be. That's another one of the myths that surround reverse mortgages. So it used to be, just so you get an idea of what we're talking about, every mortgage has a service fee built into it someplace in the interest rate or separately. So there used to be a service fee that was set aside. They take a portion of your benefit, $4,000 or $5,000, and say, we're kind of escrowing this equity. We're not going to let you actually borrow it, even though we're assigning it to you, because we need to charge you $30 a month to service this loan. That fee's gone. It doesn't exist in the industry anymore. The large fee that still remains is a 2% of the appraised value of the property, fee that goes to the federal government. I would not work in this industry if this loan was not insured by FHA. So that's a good expense, that's built into the program. For a long time, there was also a 2% origination fee, and this is where you might see some variations from company to company. Right now, I know Wells Fargo has a 1% origination fee on just the fixed products with a cap of $2,000. Other companies are charging still a 2% origination fee, maybe on all of their products or just the fixed products. But that's where you might see a little variation from company to company. But when you can do it without an origination fee, and there's plenty of opportunity for that, when you do it with no service fee set aside, it's basically a purchase or a refinance, except for the charge from the federal government, that 2%. And that's always wrapped in. Nobody ever comes to the table with that money. So it's really not that much more expensive. When you think of it, an alternative for somebody is selling a property is probably going to cost them 6 or 7 or 8% between closing costs and realtor fees. So, if it gets you where you want to go, it costs a little bit of money to get there. That's what it amounts to. Yeah.
What's current interest rate today? You keep saying it's going up and down. What's today's rate?
The rate as of today for the fixed rate is 5.06, which is, very much where the market is. But the adjustable rate is based on the LIBOR index, which is a very typically stable index, and we're under 2.5 on that adjustable rate. But it does adjust on a monthly basis.
Is there any difference if one of the parties is disabled and under 62?
No. 62, 62, 62. It's just, it's a blanket thing, so disability doesn't have anything to do with it.
Okay.
Not at all.
One
Yeah.
last question. Do all parties have to be 62 or just one?
If they're on title, then they have to be on 62. And I have to tell you very frankly, there have been situations where a father and daughter have wanted to buy a property together, or husband and wife, and you really want to be careful to look out for the best interest of that customer, because when a borrower, something happens to that borrower the day after, they purchase that property and they have a reverse mortgage, the government and the bank gives them time to sell or refinance, but they will be thrown into that process immediately. They won't have to make a payment on the mortgage, but, you know, if you've got a 62-year-old husband and a 58-year-old wife, and the day after something happens to the husband, she's really going to be thrown into a very tough situation. So I wouldn't encourage somebody, unless they had maybe an insurance policy that could pay off the mortgage. Then when she's 62, she could always refinance and get money back again. I'd be very careful in a situation like that. Yeah.
You mentioned the fellow in Pennsylvania doing a primary reverse mortgage and buying a property down here. And when he moves down here and that becomes his primary, what happens to the mortgage up north?
Well, at that point, he needs to sell his property up north. But he might just come down here for 4 or 5 months, you know, out of the year and keep Pennsylvania.
If he homesteads it, that could be a problem.
And the homestead, you have to forgive me, I'm kind of new to Florida, not in reverse, but Florida. So homestead in Florida means it's your primary residence.
Right.
Otherwise, his taxes on the property are going to be significantly higher.
Right.
Then they're going to be significantly higher.
So he has a certain amount of time to sell the property up north, or refinancing.
Oh, you mean from the time that he tries to homestead?
No, if he gets his house in Pennsylvania, gets a reverse mortgage for $200,000, buys a $200,000 house down here, homesteads it, how much time does he have in Pennsylvania to either refinance or sell that property? Because now he has it's not a primary anymore.
Right.
Well, what happens?
That's a really good question. So first of all, when are they going to find out about it? You know, so if you're going to follow the letter of the law and what's in the documents, it needs to remain your primary residence. So would they insist that, you know, the bank finds out about it, they're going to say to him, we want you to refinance or we want you to sell the property. And my advice to a customer would be to check with the service center before they did something like that, before they went to our homestead and made that second home a primary residence. That's kind of a back end, not on the front side of the reverse, but on the back end. Yeah.
Is there a cost difference between purchase money HECM versus a cash out refinance? So if that guy coming down here has $200,000 in cash already, is he better off paying cash for the house and then coming to you and taking a reverse mortgage? Is that a lower cost way to get that reverse mortgage than to put $100 down and get $100 purchase HECM day one?
You're talking about the timing. Do it as a purchase or do it as a refinance afterwards? The only difference there, he's not going to get more or less benefit.
If he has the access to cash
Right.
on day one,
Right.
Is there a cost difference of the two products?
There's no cost difference between the products. The only cost difference is going to be closing costs, third-party costs. You know, if he got an appraisal done the first time, then he's going to have an FHA appraisal done on the refinance, so that's some cost. He's going to have to pay, however it works in Florida with intangible taxes and, you know, state fees and reporting fees, and, you know, that's going to get duplicated.
Lender's title insurance.
Title insurance, right, things like that. Well, there'd be some credit, I would think, from...
But the products are the same cost.
Same benefit, same cost, yeah.
If they pay cash, is there a waiting period for them before they can actually do a refinance? Do they have to hold that property for 12 months or anything like that? Or they can pay cash and a month later apply for a reverse cash out?
Right. There might be a letter of explanation because that, you know, high risk mortgage situations, they certainly don't want to be involved in, FHA doesn't want to be involved in any kind of flipping scenario. You know, but if you say, look, I sold my home, you know, in Vermont and I came down here and I bought cash and now I've decided I want to do a reverse mortgage, there shouldn't be any hold up to anything. I'm working with somebody right now who's doing that.
All right, so the guideline doesn't require them to have held that property for any amount of time?
Right. Yeah.
That interest rate, is it or on the current loan balance after adding the interest that's been charged each year?
The interest rate, I'm sorry, ask the question again. The interest rate,
In other words, $50,000 loan at 5%, next year is at 52.5 at 5%?
Right.
Okay, so really it's ballooning.
it's negative amortization.
You're paying
Interest on interest, that's
So
exactly right. Because you
basically
financed your interest payment, basically.
Right, so what is the internal rate of return or percentage above the actual rate charged to the lender that he makes, roughly?
That the borrower,
The lender. he's charging 5%, he's adding all this interest that's
Uh-huh.
accumulating. What's an average internal rate of return that lender made on that loan, on any loan?
You know what? I'd have to find out for you.
I'm just curious.
Yeah, I don't have that number. I can tell you the theory behind how the program works with negative amortization. There's a mathematic formula that HUD came out with, and they said based on your age, the property value, and the current interest rate, how much money can we lend you today if your house is worth $100,000 and you're 62? And we're going to assume that you're going to keep it till the financial age of 100, because that's what they work on. How much can we lend you today that if those rates keep going up, and we keep adding interest on interest on interest, they're hoping, even though this loan is insured, they're hoping that by the time you hit age 100, that the value of your house is not going to be less than your mortgage. Because if it's less, and this is a really important aspect of the reverse mortgage, if it's less, this is a non-recourse loan. And the exact language is that you have limited responsibility as limited liability as a borrower. That your liability is limited to the net sale proceeds from the sale of your property. So when you go sell your $100,000 home and you net $90,000, if you owe the bank at that time $110,000, you're walking away. Because you're only limited, you have a maximum limit, and that was the net sale proceeds. So if you've passed away, you now protected your estate from being hit with that $20,000 shortfall. If you had a regular mortgage and you're underwater, that negative is going to follow your estate. But in a reverse mortgage, it will not follow, because at that point, the bank's recourse is to the federal government because the loan is insured. So and that's how they calculate it. That's why those numbers the percentages are what they are. They statistically know how long the average reverse mortgage lasts. So although they do a calculation based on age 100, I think really the number is typically 8 years. You know, I don't know how long the average mortgage lasts, but that's typically the reverse mortgage. So there are a lot of unknowns, a lot of risks for the investors and the bank and FHA, because if you do an adjustable rate, you don't know how much your loan balance is going to increase. And what you really don't know is when's that property going to get sold, and what will the market be when that property gets sold. Maybe we've gone up again, and maybe things just fell apart again. Maybe not. Maybe there's going to be enough to cover it. But it doesn't matter. You can never, ever leave a debt behind to your heirs, to yourself, or to your estate if you have a reverse mortgage on the property. You might not leave a lot of equity, but you're not going to leave a debt. Yeah.
Yeah, I was just wondering, you still can leave equity should the house be worth more than what more.
That equity belongs to the owner or whoever inherited the property.
Okay.
That's right.
There's just no.
You're not sharing equity with the bank. You're not
And
sharing.
is that the original equity, or if there were an increase in value through appreciation?
Oh, it belongs to the owner of the home.
Okay.
Yep, absolutely.
Is there any differences on the appraisal of the property?
Any
In
differences?
terms of how they appraise the property?
They're FHA appraisers. So when, I don't know if you're all familiar with FHA appraisers, not only appraise the value of the property, but they also check for structural and mechanical soundness of the property. So if there's a missing railing, somebody could fall down, FHA looks at that and says that could be a problem to us. If they're always very concerned about lead paint, so peeling paint is an issue. Any kind of plumbing or roofing or electrical things, they're not looking at decorating. But the appraiser doesn't like pink carpet or that's irrelevant to them. But personally, I think all appraisals are kind of tough these days. But they just follow FHA appraisal guidelines. Yeah.
Question.
Sure.
You mentioned chain of title when it changes.
Uh-huh.
So if you have a married couple that are both 62 years old,
Mhm.
5 years ago, and they purchased a home,
Uh-huh.
and the husband passes away and the lady's 65,
Uh-huh.
she still qualifies for a reverse mortgage, but now her equity might be upside down. Does the reverse mortgage that's in place continue until she passes?
That's
or
right.
she has to do a whole new one?
If
Because
they
it's a
were
change of
both
title.
on it,
Yes.
well, he's just going to come off. They're just going to quit claim him off because based on the death
So she doesn't have to
certificate.
do a new loan or anything?
It's in both people's names. Actually, the borrower is designated as the younger of the two, The older of the two is the co-borrower. This could be sisters and brothers, you know, it doesn't have to be our husband and wife. But the loan is going to last till that youngest person hits age 150. That's the date that the loan, they had to put something into the documents. They couldn't just leave it, you know, like a blank space. So they picked the 150th birthday of the age of the youngest borrower. Even if that youngest borrower is deceased, that loan's still going till
So you don't have to
they would have hit
refinance
age
it.
150. That's right. You never have to refinance it. Somebody else, I think, had a question? You really did great on time and like so attentive and everything. Well, it really is my hope that you can take this information to your sellers and your buyers and let them know that they have opportunity to buy a lot more house at a wonderful time to buy right now. There's some, you know, wonderful homes out there that maybe they thought were out of their reach, and they're not out of their reach. And they can live in those more expensive homes comfortably and with the peace of mind of knowing that they're responsible for the same things they'd be responsible for if they had just bought the house outright in cash. And hopefully that means higher sales numbers for you and more transactions for you. And I'm here if anybody has any questions. I'm happy to answer them.